Hello, welcome back to Chapter 2, the basic financial statement. The financial statement, we cover three basic financial statements. Income statement. Income statement summarizes the results of operations over some time period. Balance sheet lists the assets, liability, and equity of the firm at a given point in time. Statement of cash flow shows the sources of the firm's cash inflow and where the cash outflow went. These financial statements are typically prepared for each quarter of the fiscal year as well as the year as a whole. These statements help investors to judge the performance of the firm and ultimately the value of an investment in the company. Each of these statements should be in its own worksheet within the worksheet, as this will make it easy to have formulas that references other statements. Excel tools used. In addition to the formulas used to create the financial statement, we also show the following Excel tools used. Outline tools. This tool is used to selectively show and hide sections of a worksheet. We use it to hide part of the statement of cash flows, but it could be used to hide excess detail on other statements. Data validation tool. This tool is used to make sure that the user only enters acceptable values into a cell. Both tools are useful in many situations, not just for financial statements. This is an example of the income statement. The image at the right shows income statement for earnings per share for 2019 to 2020. Sales represents the revenue produced over that period of time. The rest of the items are either categories of expenses or intermediate profit measures. The basic formula for these income statements profit measures are gross profit equal to sales minus cost of goods. The EBIT, which is operating profit, equal to gross profit minus operating expenses. EBT is EBIT minus interest expenses. Net income is EBIT minus taxes. Chapter 3, Financial Statement Analysis Tools. In this chapter, we will see how to calculate many financial ratios, how to use financial ratios to make predictions about potential bankruptcy, how to calculate economic profit as opposed to net income that a firm earned in a period of time. Financial ratios are simply comparisons of two financial statement items. These comparisons help us to draw conclusions about the financial health of the firm that are not immediately obvious by looking at the raw values. For example, net income may be positive, but what matters is how large is relative to sales, asset, or equity. We will calculate 5 categories of ratios: liquidity ratios, efficiency ratios, leverage ratios, coverage ratios, and profitability ratios. Liquidity ratios describe the ability of a firm to meet its short-term obligations by comparing current assets to current liabilities. Current assets will be converted to cash, which will then be used to retire current liabilities. Current ratio equal to current liability, current asset divided by current liability. Quick ratio equals current asset minus inventories divided by current liabilities. For both ratios, higher values are indicative of a higher probability of being able to pay off short-term debts. Efficiency ratios, also called asset management ratio, provide information about how well the company is using its assets to generate sales. Inventory turnover is the cost of goods sold divided by inventory. Accounts receivable turnover equals credit sales divided by accounts receivable. Average collection period equals accounts receivable divided by credit sales divided by 360. Fixed asset turnover is the sales divided by net fixed assets. Total asset turnover is the sales divided by total assets. Leverage ratios describe the degree to which the firm uses debt in its capital structure. Total debt ratio equals total liability divided by total assets. Long-term debt ratio equals long-term debt divided by total assets. Long-term debt ratio to total capitalization is a long-term debt divided by total long-term debt plus total equity. Debt to equity is total liabilities divided by total equity. LTD to equity is a long-term debt divided by total equity. Coverage ratios describe the quantity of funds available to cover certain expenses, particularly interest expenses, so this is not the only one. Times interest earned is EBIT divided by interest expenses. Cash coverage ratio is EBIT plus non-cash expenses divided by interest expenses. We generally prefer higher coverage ratios as that indicates a level of debt that is easy for the firm to service. Profitability ratios measure how profitable a firm is relative to sales, total asset, or equity. Gross profit margin equals gross profit divided by sales. Operating profit margin equals net operating profit divided by sales. Net profit margin is net income divided by sales. Return on assets is net income divided by total assets. Return on equity is net income divided by total equity. Return on common equity is a net income divided by common equity.